What is the market telling me this week? Welcome to the Nick Rutherford Report, and the market is either going to take advantage of you or you are going to take advantage of the market. So hit that like button, subscribe to this channel, leave me a comment, share this with someone who would get a lot out of it. Anything you can do to get the word out, I really appreciate it. Especially hit that like button and leave me a comment and sharing this. And this is the place to be for the financial news that matters for your net worth. The U.S. home prices surged to new record high in June. The higher the price, the higher the GDP of the country, because even if home sales are going down, well, if the price goes up, then the GDP can go up. Make that of what it is, I have no idea. But there's some very interesting data we're going to get to. But a lot of this is, frankly, quite crazy to me. California votes to approve $150,000 in taxpayer-funded home loans for illegal aliens. So, what does this mean? It means that they're going to give $150,000 in loans to migrants, supposedly. I'm just going off the headline here. I'm not trying to be political or anything. I'm just trying to make one singular point. If things are going to get more expensive, and the government's going to hand out money, guess what? The things are going to get even more expensive. So it might be a good time to be invested in houses because, well, if the government's going to give out $150,000 in free money, well, the price of a house is going to go up $150,000. If I was owning that house and selling it, I know that's what I would do. So let's continue along with some of this crazy bearish data. The Confidence Board survey signals weakest labor market since the plague. We already knew that because if you've been subscribed and you've been watching this channel, we've already been looking at the unemployment rate slowly creeping up at an alarming rate. And you're going to have everyone say, oh, well, 4% this, it's not that bad. Well, if you look at every time, it's not that bad, and then suddenly it becomes an absolute nightmare. So this is one of the reasons why I'm becoming extremely bearish. Every day I get more bearish. Right now I'm long, though, because the data hasn't told me to really freak out because the market's still going up. We're going to talk about why I think so. Of course, come Tuesday, it could be going down. I have my crystal ball, like, it's only semi-effective. See, there's this really magical crystal ball right here. Mr. Predicto tells me everything. What's my point here? Let's continue on with some of this data. The Fed's favorite inflation indicator unexpectedly misses. Well, if inflation's going to go up, that's bad news because prices are going to go up, stocks are going to go down, but I'm going to make money because I'm invested in oil. And I'll tell you about that in a second, but that's not an endorsement to go out and buy oil because I think it's very expensive right now. And one of my principles always is for investing is buy low and sell high. Most people they don't follow the principle, even though it's incredibly simple. So one thing with that too, though, don't buy low just to freak out and sell lower because that happens too. And it happens a lot if you don't understand what you're investing in. But right now, the theme that I'm watching is that there are two economies. There's the good economy and the bad economy, and the Dollar General happens to be in the bad economy because it's serving the middle and lower class. And the Dollar General crashes the most on record after management warns of financially constrained core consumer. I guess they're buying more stuff on Temu, or they're not buying stuff at all. And if you look at the Dollar General in the last 1 month, it's down 30%. In the last year, it's down 47%, and you can see their all-time high in the 240s. It is way down. It's lost a lot of money. It's not a stock that you want to be in right now. If you read the data, it's got a lot of debt, so it's not a stock that I want to bottom feed in an attempt to pick a bottom and there either. That's not good. So let me get back to which article here. Well, I had a surging oil rally, according to this news, and that's interesting because if you look at oil, it's near its all-time highs. So we're definitely not in a recession yet if oil is flowing and people are spending money on oil. So that's like the lifeblood of the economy. You can see usually when we're deep in a recession, we have all these problems. In the 2000s, it kind of went sideways because that was the dot-com crisis. During 2007, we had the outright deflation and oil went down. When the fracking came online, oil went down. And during the plague, oil went way down. So I'm not seeing signs yet of time to freak out, but every day I get more and more bearish because I see things like Warren Buffett continues to dump his Bank of America shares. And this is not exactly what's making me bearish. It's the second order effect that's making me bearish because that just means he doesn't see anything good to buy. So that means things are going to keep getting more and more expensive, most likely, and there'll be nothing good to buy until there's some sort of crisis where the prices come down. Either that or somehow magically earnings are going to accelerate. And I'm not really sure how that happens when most of the country has no money. Like, here's another example. The RV downturn turns apocalyptic with the largest dealership offering 55% discounts. Well, let me tell you, it might not be a time to buy RV stocks, but if you want to buy an RV, it's probably a great time to buy an RV. But it could get even worse. They could be offering 75% discounts pretty soon. Who knows? But it's something I'm keeping an eye on here. Now, I just spoke about oil, so I'm going to skip over this one. But what's really important is just to remember this principle. And this is a principle I harp on all the time. Wall Street is either trying to take advantage of you or you're going to take advantage of it. And all of these articles are just designed to cause an emotional response so that many people freak out. But we got to peer through that and use the crystal ball to see the real data that really matters. And what's very interesting is here we go. We've got some real data came out this week. Durable goods soar the most since the plague. And if you look at this little chart, let me make sure it's in the viewer here. Yeah, it's in the viewer. You can see we were kind of falling off a cliff. We've been pretty well above this zero line here since the plague. And we really fell off a cliff in June, and now we have dramatically bounced back. So this is such mixed data that it's really, really concerning. We're either in the process of having a soft landing, or we're at the part where things really, really tip over. And I hate to be so bearish week after week, but I really wasn't bearish at all until unemployment went from 4.1 to 3. So it's only really in the last 2 months that I've been bearish. Since then, I haven't been bearish since 2022. So I don't want you to think that I'm bearish all the time. A sales recovery did not occur, they say. Pending home sales crashed to record low. And of course, here's the thing. Sales can go down, but like I pointed out with the article before, prices can go up. If they go up enough, that equals a higher GDP. That number feeds into all of the algorithms and stocks go up. It's just a very strange world that we live in because, you know what? If I look at the market, and this is where I want to get to the market telling me exactly what to do, and the market is telling me to be long because look at the market. The market is within inches, millimeters of its all-time high that it reached in July, which is completely wild considering such a large portion of the economy is doing completely terrible. So this is going to be the big question for the next 6 months, the next year. Do companies like Google continue to have higher and higher earnings because of their advertising and their data centers? And to Amazon, does that do the same? You know what? Maybe they can use AI in robotics to cut out some of their labor force, and then the stock goes up, and the earnings go up, even as many people are without jobs. It's going to be a completely crazy world that we're living in. And this is why I always stick to part of my investing themes of invest with the trend. And the trend clearly is to digitization. And you know what? I read all the reports from Google. I was buying Amazon hand over fist. 30 days ago, give or take a few days. And that's not a recommendation to do it at all because, you know what? If you went out and bought it now and next 2 weeks when the data comes out and it triggers me to say, all right, this is the data that really matches when we do have recession instead of it's almost the data that matches the recession, I'll be selling, the market will be going down, and we will have lost a bit of money, but it's losing a bit of money from the top, not from the entry point. My predominant entry point was before I started making videos back here in this range here. I had sold out when the data turned really bad starting on January 18th of 2022. Then I got back in here when the technicals looked really good. So, and when the data from the companies were really, really cheap, like Microsoft hadn't been that cheap in a very long time. What's my point? My point is we got to look at the data. I'm getting more and more bearish because the data just keeps getting worse, but it's not quite there. It's not quite there, so I'm still long. That's my positioning. My money's there where my mouth is. Let's look at Bitcoin. Bitcoin consolidating sideways. This to me does not seem like a downward trend, only because typically if you look at all the models, this is about the time in history where it goes absolutely bananas from now to the next year, year and a half or so. Just historically, like we're in the time frame that matches this, we're in the time frame that matches this, where it exponentially rose. And that's because if you don't know, every 4 years or so, I have to pull up the chart, the actual halving dates. The supply gets cut in half, and typically the price has gone up in the past. Will it in the future? I have no idea. But I believe that if demand stays about the same and the supply gets cut, well, price should go up. That's just supply and demand. It's kind of simple. Now, NVIDIA came out with their earnings, and they did really good. That was very interesting. And you know what? It kind of, to me, looks like it's consolidating sideways or rolling over. If this becomes a higher low and then we go up to a higher high, it's game on. We're going up. I really don't think that the AI thing is done at all. And the reason for that is every time I use the AI stuff, it just gets better and better. And Microsoft is still spending massively. And every month, and not every month, every quarter, we can read their CapEx and see how much they're spending on it. So if they're spending money on it and Taiwan Semiconductor is getting higher and higher revenues, guess what? More and more AI, NVIDIA beats. It's so simple when you just look at the data and have the market tell you what to do. So I've been in the chips for a long time. They've really, really beat me up since July, but because I was in so many chip stocks, I think my first chip stocks were back. I would have to look exactly, but I first bought into NVIDIA way back in this area here. It was like 2000. Oh, it's right there. 2017, 18-ish. I have to look in my brokerage count exactly for the date, but it was before that 2019 drawdown, and my first position was well before that. Now, what's my point? My point is that to be a successful investor, my principle is to invest in a trend and try to determine if I'm early in the trend, and then be riding that trend until I think it's over, and it's not over. And also to get out if the macro conditions say so. And that's the purpose of this podcast, for us to look at the macro conditions and just for you to see how I'm reading the market. And I'm not reading the market as red alert, but it's near red alert. It's been that way, and I expect it to continue to be that way for a little while. So what happens next, and how exactly am I looking at it? Well, unemployment could get worse, and the market could grind lower. Or unemployment could get worse, and for some reason, we're able to still have spending on data centers, and the magnificent tech stocks continue to churn up. So let me give you a quick case study of why that is a potential possibility. So here we go. My point is, in 2000, the market went way, way down, but not all stocks did. Like oil went completely sideways. And stocks like, here, I'll pull this up, Bank of America. I think the banks did really good, yeah. No, Bank of America did not do well there. They did after, but they did much better than Amazon because, well, see, the banks had their peak in 98. They really just kind of went sideways after that. What's my point here? The different segments of the economy are going to do differently. And it's entirely possible this time that we have a recession and stocks like Google just don't go down. It's possible that Amazon just replaces more and more of their workers with automation and AI, and The stock goes up even as unemployment gets worse. So this is why I always want to look at the data of the market. I want to look deep into the data of the companies, and it's just going to tell me what to do. Because it's very possible that we have this scenario, like I was talking about with oil, that just kind of not oil specifically, but parts of tech this time, profitable parts of tech with real companies, not some innovation thing that might be innovating and might work out in 10 years. But my point is we had a terrible dot-com crash and oil just went completely sideways. You didn't lose a lot of money and then it went up. So it's very possible that happens with some of this AI stuff. It's going to be very volatile. It's not me endorsing to buy it or anything. It's just like, I'm looking at the data. Look at the data. Read the data. It's not so difficult. It's just most people don't want to do it. So stick around and watch this and we'll do it together. So here's what happens next. Like I said, unemployment gets worse, market grinds lower, or market goes up even as unemployment gets worse, just because so many companies that really make up the S&P 500, they just are all digital and they're just data center focused, cloud focused. So it's entirely possible maybe their growth slows down, but they don't really get hammered. Who knows? We're going to have to look at the data and adjust accordingly. And don't worry, there will be a fantastic opportunity. The market will tell us exactly what to do. And when it does, I'll be doing it and I'll let you know exactly what I'm doing. And the other thing that I see potentially happening, and this is what I talk about every week, and I'm going to say the same thing until the facts change. Fiscal could propel the market higher. The government could spend more and more money, could goose the economy, which is going to goose the earnings of the best companies, which gooses payrolls, and everyone who's making money puts money into the stock market. And I need a drink of water when I ramble for 20 minutes here. And everything that gets its money put into it, like how when you're investing in the S&P 500, it's a lot Microsoft, Amazon, Apple, all those stocks. When someone's working, they put $100, they put $10,000, they put $100,000, they put $500,000 into a index fund. Well, guess what? A large portion of that goes right into those top stocks and they go up because there are more buyers than sellers. So there's some really, really interesting dynamics here that not everyone gets. So they've been completely wrong with their positioning. That's why I'm going to watch the data and it's going to tell me what to do. What it's going to tell me, I have no idea, but we're going to figure it out. And right now I'm long until I'm not. Because this is the last thing to talk about and then to wrap up. Well, the recession comes typically in the past when the yield curve uninverts. And it hasn't uninverted yet. The 3 minus the 10 is still deeply, deeply negative. You can see during our last recession, it uninverted and then everything was a problem. If I zoom out, you can see the same phenomenon happen over and over again, almost always. In the early 90s, we had that small recession. It was inverted, uninverted. 2000, it was inverted, uninverted. And during the great financial crisis, like, look how long it started. It was inverted practically. I say practically because this is not an exact science. This is where the quants are just, they lose me. This is like half science and half guessing with the best facts and the best research and working as hard as possible. Since May 2006, so that's like years till the crisis. So we're deeply inverted. We got a little time, potentially. Of course, there could be something that I don't see. Here, the 5 minus the 10, or the 5 minus the 0, I guess, the funds rate, is deeply inverted. Not even close, not even attempting to uninvert. And here we go, the 2s and the 10s. Looks like it's uninverting. Oh, well, we got one out of many. There could be more. I haven't looked at them all because the data is so mixed. There's no point in looking at them all. All it's saying is now is the extreme caution time. I know people preach that all the time for clicks. I'm not doing that. I'm just saying that we're getting closer and closer to this resolving one way or another. And that's why you're going to want to say subscribe to this channel. Watch it next week. Hit that like button. Leave me a comment. Let me know what you're thinking. And I'll see you next week. And the market will tell me what to do. How am I using this information to protect and grow my wealth? Go to highreturnlowrisk.com.